The Indian hotel industry is absolutely booming right now, and if you're an investor, you're probably paying attention. So today, we're putting two heavyweights in the ring, EIH Limited and Chalet Hotels. We're going to see which one might be the better bet.
So let's just cut right to the chase, shall we? The big question for this whole explainer is simple. Which of these hotel stocks is actually the better investment?
All right, here's how we're going to break it down. Think of it like a 4-round bout. First, we'll look at their two very different business models. Then, we'll check their operational scorecard. After that, we'll get into their financial health. And finally, we'll see if we can land on a verdict.
Okay, let's kick off round one and meet our contenders. Now, on the surface, they're both in the hotel game, but you'll see their playbooks for how to win are totally different.
And here's the core difference. In one corner, you've got EIH, which you can think of as the luxury purist. They are laser-focused on just one thing, running amazing, high-end hotels. But in the other corner, we have Chalet Hotels, the diversified player. They don't put all their eggs in one basket. They mix their hotel business with other real estate, like office buildings.
All right, on to round two, the operational scorecard. This is all about performance on the ground. You know, who's actually better at filling up their rooms, and what kind of prices are they charging for them?
So, before we jump into the numbers, there's a key term you need to know. Average daily rate, or ADR. All this really means is the average price someone pays for a room for one night. It's a fantastic way to measure a hotel's pricing power.
And look at this, EIH comes out swinging with a really strong ADR of 12,967 rupees. That tells you right away that they can command a premium price for that luxury experience they offer.
Now, Chalet is right behind them, but just a little bit, coming in at 12,170 rupees. Still a really solid number, but EIH definitely has the edge when it comes to price.
But you know, it's not just about what you charge, it's also about getting people to actually stay. And as you can see here, EIH takes the lead again. They keep 72% of their rooms full, which is pretty great compared to 67% for Chalet.
So here's the bottom line for this round. When you're looking purely at the day-to-day business of running hotels, getting top dollar and keeping rooms full, EIH is the clear winner here.
Time for round three. Let's start decoding their financial health. We've seen EIH is strong operationally, but does that actually translate to better profits, less debt, and just overall stability? Let's find out.
Okay, this is where the story gets really interesting. Look across the board here. EIH's financial discipline just shines through. Their operating profit margin is a super healthy 37%. Their returns are higher, and their debt is way lower. But check out that last line, the interest coverage ratio. EIH can cover its debt payments a massive 47 times over. For Chalet, it's just 5 times. That's a huge difference. Now, to be fair to Chalet, their lower profit number had some specific things going on behind the scenes. There was a one-off tax thing, but also, and this is key, higher interest costs, which of course comes from having more debt on your books.
And this comparison just drives that point home. EIH's earnings could pay its interest bill 47 times over. That's an enormous financial cushion. Chalet's buffer, on the other hand, is just so much smaller. It's a stark contrast in financial risk.
So let's recap. EIH is pretty much won on operations and on financial health. So you'd think the market would be rewarding them with a much higher price tag, right? Well, let's head into our final round and see what the market actually thinks. This is the valuation standoff. And would you believe it? Here is the big twist. After everything we've seen, EIH's stronger operations, their rock-solid balance sheet, both of these companies are trading at a very similar price-to-earnings ratio. Basically, the market is willing to pay the same amount for 1 rupee of profit from either company. Kind of strange, right?
So it all comes down to this choice right here. As an investor, what do you back? Do you go with EIH, the super disciplined, financially safe operator that's a pure bet on luxury hotels? Or do you go with Chalet, the diversified player that's using more debt which could fuel faster growth and whose stock price maybe doesn't fully account for that extra risk? So we're not going to declare one a winner over the other. Instead, we want to leave you with this one last really important question to think about. A focused low-debt company versus a leveraged diversified one. In your opinion, which of these models is built to last?